Hello, I'm April Brown with Zelken Financial Services, and I'm back with the tip. Today's illuminated point. That's right, today's illuminated point. I want to talk about merit model. Now, I believe I've talked about this a couple of videos back, like around last year. And so I wanted to bring it back up because it just got me to thinking about, insurance. And so you'll understand where I'm going with this. So the merit model, for those of you that don't know, merit is an acronym and it stands for M is for mortgage, E is for estate planning, R is for retirement planning, I is for insurance, and T is for tax planning. So merit. So some people have folks in all of these areas. Some people have folks in some of these areas, and some people have none of this at all. And so when I think about the merit model or the merit plan, what I tend to focus on is retirement planning, insurance, and tax planning. And so I have my 10-second spiel where I talk about, this is what I do. I'm talking about your retirement and your tax planning. And so those things are pretty important. And I know I've been talking about retirement. And I know folks are like, yeah. Depending on if you're in your 20s, your 30s, your 40s, or your 50s. My folks who are in their 40s and 50s, they are definitely thinking about retirement planning. When I think about merit plan, I can work with all of those folks, some of those folks, or none of those folks. It just depends on what you've got. But for the most part, as a merit advisor, I come in, I can help you and work with the folks that you have so we can come up with the plan for you, with you included, that is best suited for you in terms of what you want to do for retirement. So it is not a one size fits all. Every person has an idea about what retirement looks like for them. And I want to focus on a broader view in reference to the insurance, because I did say I'd look at that also. So insurance planning, let's talk about it. The essential part of your overall financial plan. It involves evaluating your future risk and determining the types of insurance policies you need to protect yourself and your assets. So here are some essential steps to consider when, planning for insurance. 1, you can assess your current insurance policies. So you evaluate your current insurance coverage, whether it's your health, your life, your homeowners, your audio, etc. Determine whether you have adequate coverage based on your needs. And make sure you're not underinsured or overinsured. Really important. 2, how do you identify your risk? So consider the risks that you have that you may face in the future, such as disability. I talk about this long-term care, LTC needs, or premature death. That's, where I kind of make all of that known in your 5 lives. You should watch that. So determining what type of insurance can help protect you against those particular risks. Thirdly, choose the right type of insurance. So selecting the right type of insurance depends on your risk, your budgets, and your needs. Do your research and seek professional advice to determine the policies that cover you best. Pal, this is where I come in. No. I'm sorry, I had to laugh at myself. This is where I'm going to throw that shameless plug in for Zelken Financial Services, LLC. That's what I do. Fourthly, consider insurance riders or endorsements. Yes, riders or endorsements. And what do I mean by that? Some insurance policies offer additional coverage options, and they're known as riders or endorsements. For example, a homeowner's insurance policy may have a flood rider that provides additional coverage for flood damage. The 5th piece is building an emergency fund. So if you've watched my video where I talk about the 3 N's, and they're in case, income, and increase. So we're talking about the in case. In case is where your emergency fund would fall under. And so it's really important to have an emergency fund, I'm sure you've heard it, that helps you cover unexpected expenses and prevents you from relying on tapping into your insurance policies unnecessarily. And what do I mean by that? If you have an IUL, which is an index universal life policy, some people might tap into that to pay for something. And what we're saying is if you have an emergency fund, you don't have to worry about that. Aim to set aside at least what we say is really 3 to 6 months worth of living expenses. So your basic living expenses in that emergency fund, because that goes into your what? Taxable bucket. And if you know anything about the 3 buckets, the taxable bucket is, for tax perspectives, one of the worst places to keep your money. It does provide certain things, which is liquidity and easy access and those kind of things for your emergency fund, but you want to make sure you don't have more than 3 to 6 months worth of monies in that particular fund. Make sure you're reviewing and updating your insurance. And what I mean by that, it's important to periodically review and update your insurance policies to ensure that they are continuing to meet your evolving needs. And what do I mean? If you have, for instance, an IUL, Index Universal Life Insurance, make sure you're meeting with your agent at least once a year. At least. They really should probably meet with you like twice, but at least once a year, because what happens is you want to make sure that what it's doing is supposed to be doing, and if there's any changes or there are any things that you need to adjust, so on and so forth, you can go over that. And so making adjustments to your coverage when necessary, and possibly considering new insurance policies as appropriate. And what I mean by that is if you have a policy that you've had for a long time and you look up and you realize, oh, there might be other vehicles that are better, that may be able to provide you additional things within that particular policy itself. So you might consider, okay, we're going to leave this one and move to another one. But that is a consideration. That's having a conversation with your agent to discuss, just kind of if the policy is really working in the way that you want, and maybe there's a better vehicle for you. So just food for thought. So remember, retirement is the time to relax and enjoy life. So if you start planning early for retirement and tax planning, because they really do go hand in hand. If you don't believe me, I'm trying to tell you, they really do. Careful consideration in creating a solid plan, a solid retirement plan is really important. That's going to suit your specific needs and ensure that you have a comfortable and enjoyable retirement. And that's pretty much it in reference to insurance planning. So I am April Brown with Zelken Financial Services, LLC. I hope you got something out of this. And until the next time, have a great day.